Today, we're diving deep into the world of hedge funds. You know, that super secretive club of billionaires who control trillions of dollars and kind of shape our economy from the shadows. But what if I told you that this entire hyper-capitalist industry was actually created by a former anti-fascist spy who was a huge fan of Marxism? Yeah, the real story is way crazier than you think. So this is the image we all have in our heads now, right? These hedge fund titans are basically our modern-day Rockefellers. They have personal fortunes that make the CEOs of the biggest banks on Wall Street look poor. It's wild. In less than a generation, they've become this new American elite, a symbol of just unimaginable wealth and power. But how did we get here? Was it always about $50 million private jets with cribs in them? Well, to really understand the world of hedge funds today, you've got to go all the way back to its surprisingly radical beginnings. Okay, you really got to see this to believe it. The image we have of some slick, hyper-capitalist trader could not be more wrong when it comes to the guy who started it all. The inventor of the hedge fund wasn't a Wall Street shark. Nope. He was a sociologist, a former spy, and a guy who spent most of his youth fascinated by Marxism. So, let's meet him, the incredibly unlikely founder of this whole industry, a man named Alfred Winslow Jones. He'd eventually become a kind of patriarch of Wall Street, but honestly, he never really seemed to fit in. I mean, you just can't make this guy's life up. Before he ever even thought about an investment, he was a diplomat in Germany right before the Nazis took over. He joined a secret anti-fascist group. He even hitchhiked to the front lines of the Spanish Civil War and partied with Ernest Hemingway. It was only when he was 48 years old, after a whole career as a journalist and academic, that he basically said, you know what? I need to make some actual money. And get this, he started with just $100,000, 40,000 of his own cash, and 60,000 he got from a few buddies. From this tiny little seed, an industry that would one day control trillions of dollars was born. It's incredible. So what was this big idea he came up with? What exactly was this new hedged fund that Jones almost stumbled upon by accident? And here is the central paradox, the key to the whole thing. Jones's goal wasn't to make a bunch of wild, risky bets. It was the exact opposite. He wanted to use financial tools that everyone thought were super speculative, even a little shady at the time, for the incredibly conservative goal of protecting his money from a market crash. So his model, it really boiled down to 4 game-changing ideas. First, he took a 20% cut of the profits. That gave him a huge incentive to perform well. Second, he set it up as a private partnership, which meant less regulation and a lot more flexibility. Third, and this is the famous part, he hedged. He would buy stocks he thought would go up, while at the same time betting against stocks he thought would go down. And finally, because he felt his money was now protected from the market's big swings, he used borrowed money, leverage, to make his bets even bigger. Okay, check this out, because this table shows you the magic. In a good bull market, a regular investor does pretty well, but the hedged investor using that borrowed money does even better. But here's the real kicker. Look at the bear market. When the market tanks and the conventional investor is losing money, the hedged investor, because they bet against some stocks, is still profitable. It was an absolute game changer, a structure designed to make money no matter which way the market was heading. All right, let's jump forward to the crazy, turbulent 1970s, because this conservative little tool that Jones built was about to get picked up by a new and much, much more aggressive generation of traders. And that brings us to Michael Steinhardt. This guy was the total opposite of the quiet, professorial Jones. He was a loud, intense trader from Brooklyn. And he took Jones's structure and turned it into a weapon, a vehicle for betting against what everyone else believed, on a scale that would, as one author put it, terrify a normal mortal. And you can see the results right here. Between 73 and 74, the stock market got absolutely crushed. It lost 43% of its value. But Steinhardt? His fund was up a combined 40%. The rest of Wall Street was a smoking crater, and this guy was making a fortune by being a total pessimist. So how'd he do it? His whole strategy was just pure contrarianism. It was an era of optimism, but his firm would dig through company reports, find all the super-hyped story stocks that were built on nothing but hot air and shaky accounting, and then bet millions that they would collapse. And they usually did. So what's the common thread here? We have the intellectual Alfred Jones and the intense Michael Steinhardt. What's the one secret goal that connects these two totally different guys? It's all about the relentless, all-consuming search for an edge. The game wasn't just about hedging away market risk anymore. It evolved into a hunt for some kind of unique insight, some piece of information nobody else had that would let a manager consistently beat everybody else.
Now, to really get this, we need to understand two key terms. First up is beta. Just think of beta as the return you get for just showing up. The market goes up, your stocks go up. It's the tide that lifts all boats. You don't have to be a genius to get beta. And then there's alpha. This is the holy grail. Alpha is the extra return you generate on top of the market. It's the part that comes from a manager's specific skill, their edge. Alpha is the proof that you're not just lucky, you're actually smarter than everyone else in the room.
And this constant high-stakes hunt for alpha has kicked off this huge debate that is still raging today. Are these hedge funds a force for good in our economy, or are they a danger to all of us?
And there are two completely different schools of thought. The hero's view says that these funds are like market watchdogs. They find things that are mispriced and they fix them, making the whole system more efficient and stable. But the villain's view says they're just reckless gamblers, pouring gasoline on fires, amplifying panics, and posing a huge threat to the entire global economy. At the end of the day, it really boils down to one thing: leverage, that borrowed money. It's the very tool that gives hedge funds the power to move markets and correct prices. But it's also the very thing that makes them so dangerous. A small mistake can be magnified into a catastrophic loss that can cause an incredible amount of damage. And that brings us to the biggest question of all, one that's become even more important after all the financial crises we've seen in the 21st century. So I'll just leave you with this question. In a world that's always going to have financial risk, who would you rather have managing it? The gigantic, too-big-to-fail banks that we, the taxpayers, have had to bail out before? Or a whole bunch of smaller, scrappier hedge funds that have to live or die by their own decisions, with absolutely no expectation that the government will ever come and save them? The answer to that question could very well define the future of finance.